Let's look at problem 5-26. This involves journal entries, T accounts, and cost of goods manufactured and sold. During May, the following transactions were completed and reported by Jericho. Okay, we've got 5, 6, 7, 8, 9, 10, 11, 12 or 13 transactions. And they also give us materials inventory, work in process inventory, and finished goods inventory. Okay, so here I've listed the first requirement. They tell us to prepare journal entries to record the transactions occurring in May. And for a compound transaction, if the amount box doesn't require an entry, leave it blank. Okay, now I've adjusted the screen a little bit so that you can see the solutions on the right side. You may have to go to full screen to read this legibly. Okay, so for transaction A, materials purchased on account $60,100. What do? We debit the materials account and credit accounts payable. Transaction B says we issue to production to fill job order requisitions, direct materials of $50,000 and indirect materials of $8,800. Okay, so work in process gets debited for the direct materials. The overhead control account gets debited for the indirect materials. And they both come from the materials account, so we have a credit of $58,800. Transaction C says payroll for the month, direct labor $75,000, indirect labor $36,000, administrative $28,000, and $19,000 for sales. So our compound entry, the direct labor goes to work in process, the indirect labor goes to overhead control, and then our period costs go to administrative and expenses and selling expenses, $28,000 and $19,000, with the offset going to wages payable. Okay, and the offset is the credit in this case. And transaction D says we have depreciation on factory plant and equipment. Well, depreciation on factory plant and equipment means it's an overhead item. It's an indirect cost of manufacturing the product. So the debit is to overhead control, the credit is to accumulated depreciation. For entry E, we've got property taxes related to the factory, accrued of $1,450, again a debit to overhead, a credit to property tax payable. Entry F says insurance on the factory expired with a credit to the prepaid insurance account, so we know we're going to credit prepaid insurance by $6,200. What are we going to debit? Well, we're going to debit overhead, again another indirect expense or indirect cost related to the manufacturing aspect of our business. How about G, factory utilities? Again, overhead $5,500, credit to utilities payable. And now I need to adjust the screen. Okay, so now we can continue. After the entry G, which was factory utilities, we have entry H, advertising paid for cash. Well, that's just a debit to advertising expense, $7,900, or a debit to selling expense. I guess they're not giving us a separate advertising expense account. Credit to cash. Entry I says depreciation on the office equipment was $800 and sales vehicles $1,650. Now, entry I has nothing to do with manufacturing, so it's not going to impact a manufacturing overhead account at all. And you can see right here we've got the debit to administrative expenses and selling expenses and a credit to accumulated depreciation, which is what you would expect. We always use a contra depreciation account, and you learn that from your financial accounting course. Entry J, legal fees incurred but not yet paid, another administrative expense that gets accrued. So we're going to use the offset account of accounts payable to show that obligation until we pay it. Entry K says overhead is charged to production at $18 per hour per direct labor hour, and 4,000 hours were used. So 4,000 times 18 is 72,000. We've got a debit of work in process and a credit of overhead control. So this is actually our overhead applied entry. Some companies would actually use a separate account called overhead applied. This particular illustration is using an overhead control account. Okay, entry L is cost of jobs completed, $160,000. When we complete a job, that's when we credit work in process and we debit finished goods. So it's now left the production process and it's ready to be sold. Okay, now in the bottom area of the screen, I reposition the screen again, and here's question 2 with the answer related to this problem. Number 2 says, prepare T accounts for material inventory, overhead control, and work in process and finished goods. Post an entry to the T account in the same order in which they were journalized. So here's material inventory as an example. They give us a beginning balance, 7,500, and then we had entry A where it was increased by 60,100, right? And entry B where we issued to production of 58,500. So that's how you'd come up with an 8,800 ending balance for materials inventory. Okay, now I've put finished goods inventory on the screen so you can see how that balance changes. And this one's even easier. We started off with the 50,000 and the only entry we had was the 160,000 from entry, was that JK entry L. So we've got a debit to finished goods. Again, we would expect a credit when we sell it, right? We would credit finished goods inventory and debit cost of goods sold, but we haven't seen that transaction. So all we have is the beginning balance plus what we increased in finished goods for this example problem. All right, now requirement 3 says prepare a statement of cost of goods manufactured. And what you have to do here is have some understanding of what the format of a statement of cost of goods manufactured looks like. So we would list direct materials, labor, and then the various overhead costs or accounts we had, list them all, add them up. We would add any overhead applied to it to come up with what was the total overhead applied. That would give you what the total manufacturing costs were that were added. Then you would add in beginning, subtract ending, and you'd come up with cost of goods manufactured. Okay? So all of these came from the T accounts, either the information that was provided or the new balances that you calculated, right? And in this case, they tracked separate overhead by supplies, indirect labor, depreciation, property taxes, but all of that will be added together to show what overhead we had, as well as any over-applied or under-applied overhead. Now remember, if we had over-applied overhead, that means that there was more applied than what actual overhead was incurred. They applied 72,000, but only 68,350 was actually found in our actual expenses. So the difference needs to be put in there to come up with the difference between actual and what was applied. Okay, now I've moved the screen a little bit just to show you how we came up with the support for the overhead area. Right, we had all the various transactions that they gave us saying what overhead was incurred, and then we showed the 72,000, the credit of overhead being applied, leaving a balance of 3,650. So that means we were over-applied. If the credits exceed the debits, we're over-applied. If the debits exceed that applied balance, then we are under-applied. All right. Now next at the bottom of the screen, we tackle the last part of this question, which asked us to come up with how much of a change and by how much, well, whether it increased or decreased and by how much. And here's the question. If the overhead variance is all allocated to cost of goods sold, by how much will cost of goods sold decrease and increase? And that's that 3,650, the over-applied amount. The reason why they're asking you, if it gets all applied to cost of goods sold, that's typically what is done when the difference between under-applied and over-applied is relatively small. If the difference between under-applied overhead or over-applied overhead relative to total cost is large, we may want to allocate that difference between cost of goods sold, work in process, and finished goods. But in most businesses that I've seen, it all just it flowed through to cost of goods sold, and that's why we're seeing it increase, showing it as part of cost of goods sold here.